Okay, so welcome to today's meeting, everyone. Today we are going to go through two things, and I think these two things are, one of them is really relevant today to today's environment, and one of them is really relevant to all the business that we do. So I'm pretty excited about it. I don't know. I wanted to share that I did actually have a dad joke. I was going to say that this is very interesting. Anyway, it's mortgage related. Wah, wah. I tried it on someone else today and it was also a wah wah. So anyway, okay. First things first, we are going to go through a little bit of detail about what's happening in today's market with regard to interest rates, so fixed versus variable. And we're also going to talk a little bit about strategies on what people are doing moving forward. Brian, I'm just going to mute you because I can still hear myself. Okay. So what I'm going to do is I'm going to create, this is going to be like a trivia, and here are the ground rules for the trivia. Everyone has to participate because I'll tell if you're not trying. I can tell. Yeah, you too. You have to participate. And here's how we participate. You're going to unmute yourself and you're going to say, I've got the answer. You can't blurt the answer out because I will then tell you, okay, this person was the first person to unmute. And then you can say the answer. All right, so I'm going to ask a question, you unmute, and the first person that I hear that's unmuted themselves that says, I have the answer, can then, after I say, provide the answer. If they get it wrong, we'll go to the next person. Okay, there's a few questions, but this is going to get us to the discussion about what the heck are we going to do with clients today. Okay. So question number one, you guys all ready? Is everyone ready? Okay, we got some head nods. Okay, good. All right. For those of you that I've done training with, this should be like instant. There's 3 transaction types in mortgage brokering. What are they? Are
we supposed to chat it or?
I have the answer.
Who's got the answer?
Oh, Mr. Cotta, pick me, Mr. Cotta.
I heard someone say Brad does. Brad does. So Jane, you weren't listening to the instructions. You're supposed to say, I have the answer.
Okay, I was putting lipstick on actually.
Okay. Hang on one sec. So I heard Brad chime in first. So the rest of you mute yourselves. Brad, 3 transaction types.
Purchase, refinance, transfer.
Yes, Brad gets a bonus. Okay, so the reason that I'm asking you guys these questions is because you're going to get your name into the draw for today's gift card. So if you answer one of these questions right, you're going to be one of the few. Okay, so Brad's in. Well done. Okay, you guys all heard that? Purchase, refinance, transfer. Those are the 3 major transaction types in mortgage brokering. Always know those 3 because everything kind of revolves around that. The other ones, there are a few others there, but really they aren't as important. Okay. There are also 3 insurability types. Name 3 insurability types.
I got it.
I love this. You guys are in. Kristen, I heard you first. Rest of you mute. Kristen, go ahead.
Insured, insurable, and uninsurable.
Correct. Awesome. So Kristen's in. You might be wondering, where the heck am I going with this? This is just such a review. It's all basic. Okay. I'm going to ask you one more question that has a 3-part answer. Who can name the 3 different rate types? And there are 3 because they all are a little bit different.
Pick me.
Brad, you've already answered one right. No?
I have the answer.
Okay, Frank. It's Frank.
So we have fixed, variable, and adjustable.
Yes. Oh my God. You guys are so good. All right, Frank got it right. Okay, there's 3s. I love working in 3s, primarily because Martha Stewart always says you do everything in 3s. So this works really well. All right. So we've kind of gone through the real basics of
Did
mortgage
go to
brokering.
jail.
What's that?
She did go to jail.
Well, that's just a minor issue. I mean, who hasn't had a little jail time, right? Okay. Okay. So I'm going to call this, we'll call it the penultimate question. So the second to last question. Okay. So what is the requirement for something to be insurable? You've got to name at least 4 things.
Oh, is that what Howard was like? I can never remember. Mhm,
Who's
mhm.
got it? I don't hear. I have an answer.
I got the
25-year
first.
Amortization. Is that what he
Jane,
had?
you're unmuted. Does anyone have an answer? Come on, if you can get most of them, I will give
I
this.
have the answer.
Okay, Cornelia.
I have the answer, but should I give somebody else a chance?
Yes, Brad, you're already in there. You're set. Okay, so Cornelia, go ahead.
Okay, max 25-year AM, purchase, owner occupied or principal residence. And was there 4?
I would say there's 4.
Did I say under $1 million?
Nope. Awesome. Nailed it. Okay, so we've gone through what it takes to be insurable. Cornelia, you're in.
Thanks.
Last question. Now you guys really have to put your thinking caps on. If something was refinanced, let's call this mortgage refinanced last year, can you switch that to a lender as an insurable file?
I have the
I'm
answer.
Okay, Lindsay.
No?
You got that one wrong.
Yes,
Jane? What's that, Jane?
yes.
Jane, you gotta do this right. It says, I said the rules are you have to say, I have an answer.
Oh, I'm sorry. I didn't sleep very long last night putting this event together. I'm so
Okay.
tired right now.
No problem. You're still gonna get
The
an X
makeup.
for that. I'm waiting.
I know the answer.
Okay, thank you. All right. So the answer is?
Yes.
Okay. And as a follow-up,
Oh, no.
is there rules to be able to do it as an insurable transfer?
Yes.
What are they?
Oh, sorry. My phone's going.
Nice. I don't take advice
Sorry.
from Deb. I can see Deb's lips moving.
They are. Let her answer. Oh,
So it's
not even.
It's the same as what Kathy just said.
I did mute it.
Sorry, no, it was Cornelia. It's same as what Cornelia just said, which is that it still has to meet all the requirements of an insurable file. So it still has to be max 25 years. It still has to be, it still has to be under $1 million, less than 20% loan to value, less than 80% loan to value. All those things have to apply to an insurable transfer. Okay, so what is the reason that I've done this for you guys, this little mini trivia, and by the way, I'll get to doing the draw, so there's 5 of you in the draw, is because there's an interesting scenario that's developed lately, which is that we may have had clients take variable rate mortgages, or more specifically, adjustable rate mortgages. And those adjustable rate mortgages have had their payments go up and up and up. As these payments have gone up, a lot of people have wanted to lock in with their existing lender. The interesting thing that's happened lately is that some lenders are not giving great rates. So if a client goes in and wants to lock in, the rate is not phenomenal. It's usually in the 5s. That's kind of what they're being offered. So the thought occurred, Frank, I can actually see you. Awesome. There's 2 Franks. So the thought occurred, and I think Deb had mentioned this, is can you actually do a file where it may have been uninsurable previously, but then bring it into insurable as a transfer? And the answer is yes. So we've gone through kind of the way to do this. So if you wanted a client to kind of get potentially a better rate, not only do they have to fit into the boxes for an insurable transfer, but there's one other thing that the client will kind of have to agree to, that in order to do this switch or transfer. So I'm going to give a bonus question to anyone that can answer. What other thing does the client have to agree to if we're going to transfer them from one lender to another?
I know.
Are we allowed to let Deb do this? Is everyone okay with this? Okay, we're good. All right,
Client
Deb.
has to buy me a beer.
Okay, Deb's got to buy us all a beer.
I'm not answering that.
It's like getting a hole in one. You got to buy.
They have to agree to pay the penalty.
Yes. Okay, so there's the thing that Deb gets a bonus mark. She actually won't be in the draw anyway, so I won't tell you. Anyway, good job, Deb. Well, there's no point in you getting your own gift card. All right, so that's the one thing.
So wait a minute. You make the rules, you make the trivia game, but I'm buying the gift cards?
Well, no, White House buys the gift cards.
Oh, okay.
Yeah.
Okay.
So the clients have to agree that if they do a transfer, that they're going to pay the penalty to go from their existing lender to the new lender. Okay, I'll throw in one more bonus question. How much is the penalty?
Peter, can I comment on the penalty? And by the way, I know the answer. It's 3 months interest.
Come on, you're supposed to let other people do it.
Oh, well, too bad.
Okay.
So the other thing is to remember that some of the lenders will capitalize that penalty up to $3,000.
Stealing on my thunder. These are part of my questions. I should have gone through this before. It's all good. Okay, so absolutely valid. So if a client does choose to go and do the transfer, penalty is going to be paid to the existing lender. They're going to have a penalty as part of the discharge. And that penalty is typically, for adjustable rate mortgages or variable rate mortgages, is typically 3 months interest. So 3 months interest is usually not a huge amount. But remember that most times when we do a transfer, that the penalty can be capitalized. And Deb, because you're on a roll, what is the maximum that most lenders typically allow for capitalization?
I thought I said it already, $3,000.
Right. Okay, perfect. So 3,000 max capitalization. So if your penalty is above 3,000, the client will have to pay out of pocket. Okay. So bringing this back to the, go ahead, Cornelia.
I'm not quite following the scenario. Are you saying that anybody who was in an uninsurable product can switch to an insurable product and just pay the penalty, even if they were in a fixed mortgage, or no?
No. So you can, that could be possible, but the whole idea of this came from the fact that people that have had variable rates or adjustable rate mortgages specifically have had their payments go up. And a lot of these people have wanted to lock in. So as they've kind of had the discussion with their existing lenders, some lenders haven't given necessarily a great rate for locking in.
Mm-hmm. If
we look at what an insurable transfer is, the rates are typically in the mid-4s right now. So if they're being offered 5.39 at the existing lender, and we can get 4.69 from one of the monolines, then there might be a case to be made that says, hey, if you do lock in, you know, your interest savings over the course of 5 years from having a 4.69 mortgage will outweigh the penalty if you had to pay it on a 5.39 mortgage.
So if their mortgage is currently conventional and 30-year amortization, as long as they put it back to 25 and all the other, like under $1 million less, but it'll be more than 80% loan to less than.
Typically below, yeah.
Yeah, okay. If it was previously insured and they had refinanced it, and then you do a transfer to make it insurable and get the lower rate, are they repaying insurance premiums, or it's just that it's insurable so they don't have to pay the premiums?
Correct. So anytime that something is insurable, the client does not pay that insurance premium, because typically what happens is the lenders will call these mortgages insurable. They will fund a whole bunch under this insurable program because they fit all the requirements of being insured, but they take those mortgages and they bundle them together, and they actually get kind of a bulk insurance that they can then insure and then sell them off. So clients will never see the insurance premium. Clients don't pay the insurance premium, but they are still considered insurable, and the insurance kind of happens behind the scenes.
Okay. Thanks, Pete.
Yep. Okay, so that's the reason that we're kind of looking at this scenario. Again, max capitalization up to $3,000 of that penalty. So we wanted to give you guys a bit of this sense, because we're having a lot more discussions with people that may have had these variable or adjustable rate mortgages. They're contacting us. I think especially this kind of came from Deb's clients who talked to Scotia, right? And Scotia wasn't necessarily giving great rates. Actually, First National as well wasn't given phenomenal rates. Yeah. So First National was given in
So
five
what
something.
happened there? I might go in the hallway, Jane, because I'm echoing. But what was happening is that I was sending in requests to First National to find out what the 5-year fixed rate was. They were coming back at 5.04%, even though for a brand new purchasing, they were offering 4.59. Now, I had clients with Merrick, CMLS. I sent in a request and they came back at 4.59. So I went back and I bitched at Sarah and I said, Sarah, what gives? Like, this isn't, she goes, well, no, give me names. No, nobody else is doing this. And I'm like, no, here are the names of who is doing it. So she sent me an email and was looking it up. And I said, okay, well, this is what's happening. So she said they might be making changes, but I wouldn't guarantee anything. And then the other thing is that like they're offering 5.04 to 4.59. So I just got a client's penalty. He's got a $610,000 mortgage, I think, and his penalty was $5,200. So we've got to figure out if that makes sense to switch him over to the 4.59. Now, saying that, I don't know if you guys saw that some of the lenders, the rates have come down to 4.54. And I was talking to my girlfriend Marcy at the Coast, and she's going to be sending me the notes. I thought they were going to have been here yesterday, but she got sidetracked. So she went to a seminar with Equifax and Benjamin Tall yesterday. And in that comment, Equifax was saying they're already seeing insolvency issues, okay, that is happening because of this rate hike. Benjamin Tall was commenting that he thinks that there's going to be probably one more rate hike with the prime, and then probably late a Q1 that the prime and the bond rates are going to come down. They also expect that the 5-year rates are probably going to come down in Q4, which is where we're at right now. So probably November-ish that they're going to be coming down. So I'm just waiting for Marcy to send me those notes and I'll share it with you. So it's kind of a catch-22 situation. Do you tell your clients to lock in now, or do you ride the wave and take the chance, right? Because we know that there's going to be one more rate hike. And, you know, if you bank on 75 bips, that makes prime 6.25. And if they're at prime minus 1.1 or prime minus 1, well, they're going to be at 5.2, right? So is that really worth it when they could lock in at 4.59, but our rate's going to come back down for insurable, right? Now, Cornelia, in regards to your question, Peter, I want to look into that a little bit more, because if they bought it as a purchase like 3 years ago, and then they've already refinanced, that makes it uninsurable. So I don't know that it could be switched. So I want to check into that. And
I checked in with Kim at RFA. They'll do it.
Yeah, I still want to check into it. So, because it's Kim. So the other comment I wanted to make was that Jane had commented, oh, then they're going to have legal fees. When it's a switch, if there's legal fees or an appraisal being required, the lender that you're switching it to, they will pay all of that as long as it's a direct switch. Because the minute they change the amortization or the mortgage amount, that makes it a refinance. And so then they're going to have to pay the fees themselves. That's all I got to say about that.
Yeah, because part of the thing that I was thinking was exactly what you were saying, Deb. If they are currently in a 28-year AM remaining, and in order to bring them back to insurable, we have to change that amortization to 25. Then we're changing
go down the hall.
How it's registered, and it doesn't become a switch. So I'm a bit confused on that part.
Well, like I said, I'm up in Prince George right now, and there's an event this afternoon. So First National is here, TD is here. Who else is here? Jane, anybody else?
Community Trust. Well,
Yes.
he's not coming, but
So,
that's our
so anyway, I'm going to talk to both of them about the switches and see what they say.
There's definitely some outstanding questions, and I tried to do as much digging as I could prior to this. So I'm happy that Deb's up in Prince George and that there are some lenders there that this question can be asked of. Also, another question is, what value is being used to determine the value of the property? Was it the value when it was originally purchased, or is it the current value? Because if the current value maybe is up from where it was purchased, then maybe it's kind of gone beyond insurable. So I don't know the answer.
But Peter, when it's a direct switch, they usually use the purchase price of what it was, right? And even if it has gone up and they use the higher amount, it still makes it insurable.
Okay. Definitely a good question about the amortization, though. So that's the bulk of kind of the first part of this meeting. Is I wanted to go through that part. We'll follow up after Deb's had a chance to chat with some of the lenders. Well, maybe what we'll do is we'll kind of follow up next week to kind of go through how that looks and whether that is available to us. But in the meantime, just wanted you guys to have some thoughts going on in terms of what that looks like. Okay. The second part of this meeting is about velocity. And so if anyone feels like they're velocity kings, then feel free to pop off. I don't know what Deb's up to there. They're obviously joking around.
Because Jane is painting her toenails.
Okay. This is not just a broker meeting. It's also a
Well,
pedicure.
we've run out of time and we have to be at this event around the corner. And I'm thinking, I have to repair myself. I've got no makeup on. I'm a wreck. And yeah. But I got 43 people coming, so.
Perfect. And you'll have pretty toes. There you go. All right. Okay. So yes, the second part of this meeting is all about velocity. And I wanted to go through 3 different scenarios, because again, I'm all about the threes. Oh, you guys probably want to know who won the draw. Okay, so let's do that. Let's go to the draw here. Okay, so I put in the names of the 5 individuals, minus Deb, of course. Deb, you didn't get in. But we've got Brad, Kristen, Frank, Cornelia, and Jane. You guys are seeing this live, so here I go, clicking the spin. I love this little spinny thing. Jane! Oh my gosh, Jane wins the gift certificate. Oh, you guys probably can't hear this, but on my audio, there's clapping. All right. So that's really cool. All right, so let's stop that. Okay, so Jane, just get Deb to take you out for dinner tonight. That would work.
Okay. Thank you. Thank you kindly.